are actually really good. If according to Peter, it is time to borrow, 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 because over the next several years, the US economy will see higher rates, not lower. We will break that down. We need to talk about PPI this morning. Did we get our first hot inflation read of the week? We will, of course, talk about active inventory from Altos Research. We will talk about billions and billions of dollars lost by short sellers. Let's get into it, folks. Lots of stuff to talk about today on the daily financial news. We're going to go into PPI first because that was market moving this morning. Again, folks, remember when we talk about inflation, we talk about two components. There's headline and there's core. And then we talk about year on year and month on month. So we will be talking about four numbers. We will get into headline first. Headline, last was 2.1. Estimate was 2.2. So again, it was expected to go higher. What happened? It did indeed go higher. It came in at 2.2. Now we will talk about headline month on month. This is the one that came in hot. So again, last came in at 0.2. It was estimated to go up 0.3. Lo and behold, month on month headline came in at 0.5. That is a significantly higher beat. Not good. Inflation is still a problem. I think this marks like the fifth, maybe even the sixth inflation reading that has come in hot and above expectations. Now, let's step back and look at core, right? Because we know that there's some oil and gas and energy that can make headline a little wonky. Again, core year on year, last was 2.4, estimate was 2.4, actual 2.4. Month on month, this is where it becomes a problem once again. Estimate was 0.2, last was 0.2, actual, again, a significant beat at 0.5. When you look under the covers of PPI, it makes me even more concerned. According to some early readings of the data, 75% of the increase is in services. Why is that important? Well, services, if you don't know, is predominantly made up by wages, right? Wages are the largest component of services. And if we are continually seeing beats by services on inflation, that means maybe Powell has to go higher. Now, the big number is tomorrow. Again, we will get a reading on CPI. We will also get a reading on retail sales. CPI is, I don't know, significantly more expensive or more important for the Fed. PPI is what producers pay, think wholesalers. CPI is what you and I pay. So again, this is kind of the appetizer to tomorrow's report. Again, when I looked at the data, I just have a uneasy feeling that the market is set up for a surprise. Again, the market as of yesterday, I did not check this morning, expects CPI to go down. And I think there's a chance it actually goes up or stays flat. So again, we will know in about 24 hours where inflation is for the month of April. Now, let's talk about this video from Peter Zeihan. Peter Zeihan, monster YouTube channel, really, I believe, kind of an expert in geopolitics, expert in demographics. I was sent this 8-minute video of Peter, I guess on a hike is what I think he was doing. But the 8-minute video talked about interest rates. And I was very thankful that several of you sent me that video. Just so you know, I've also shared it with Anna Kelly. Anna and I will be talking about that video together to see what she took from it in about a half hour or so. But back to Peter's point. Peter's point is no rates are coming. He sees the demographics of baby boomers starting to liquidate all of their wealth, meaning that over the next 2 to 5 years, rates won't be going down. They could actually be going up. He's talking about rates not being cheaper into the mid-2030s. Think about that. Higher for longer means 2035. 2035. If Peter is right, what about all those people that did the whole buy the house, date the rate thing? Yeah, 2035. Now, as all of you have asked, what do I think of that? I think it is an interesting riddle. I do say that I think the Fed, specifically Powell, is positioned to cut. I think Powell wants to cut, but obviously inflation is a problem. I had not looked at or thought about the demographics as Peter postulated, so that was very interesting to think about. There is a lot of wealth. I think I saw a report the other day that the baby boomers have about 50% of all the wealth. So if they really do start to liquidate that, that could prove problematic. But here's the real question. Could we not see a rate cut for 2024? Absolutely. And if you go back and watch videos from late last year, I said that could be possible, even when the market said 6 cuts. Could we not have a rate cut through 2025? I think that's unlikely. And the reason that's unlikely was actually something Peter did not talk about. Is the fact that I need to check this, but I believe it's true. I believe Jerome Powell's term as Fed president ends like April of next year. So why is that important? Let's just pretend you're the president. You're either Trump or Biden. It doesn't matter. And you want rates lower. And you have the ability to nominate the next Fed chair. Who are you likely to nominate? Somebody who's going to continue to be hawkish and want to carry the mantle of no cuts? Or are you going to pick someone that you think you can bully? I think the answer is probably obvious to you, or at least as obvious to me. So I do believe Peter is right, that while Powell is in office, having no cuts through, let's call it Q2 of 25, is possible. I think it is unlikely that the president will be nominating a Fed president that will be as equally hawkish. So I think that's one nuance that I did not hear Peter talk about, but it was very, very interesting. Think about that. No rate cuts through 2035. What does that mean? That means no black swans. That means no recessions. I don't see how that happens. How could we go 5 years without a significant recession or a black swan, something breaking? If we have higher rates for much longer, commercial banks will start to break. It's like one of those mathematical certainties. Now, the commercial banks, they may be able to band-aid over with some off-the-shelf, extend and pretend. I don't think the U.S. economy can grow another 5 years without an event. So I don't know. It was an interesting video. And again, as I mentioned, I shared it with Anna Kelly. We should be talking about it here in about a half hour or so. Other things that we talked about that are important today is the GameStop, AMC, short sellers now have lost $2 billion. $2 billion on paper. Yes, folks, they lost $1 billion on Monday, and as the market opened, they lost another $1 billion. This is pretty crazy. So again, pretty interesting to look at these meme stocks. And I do think it's interesting, right? There's a lot of folks who say the consumer has no money. All of the doomers say the consumer has no money. Well, where's all the money coming from retail to buy these meme stocks? There's money somewhere, right? You're not buying these things on credit cards. So there's definitely some money somewhere sitting on the sidelines. It just goes to show me that the consumer may not be as broke as all the doomers want you to think. And of course, folks, if you've made a big profit, do me a favor. Take a little bit off the table, right? Take a little bit off the table. New York Fed survey, very important. Looks like the inflation outlook has gone up. It was 3%. It's now 3.3%. This is not good news because, again, this is a consumer survey and we as consumers drive the economy. Where do consumers see the inflation? They expect rents. Consumers expect rents to go up 9.1%. That seems high to me. But again, the consumers expect that. College education continues to get more expensive. They expect that to go up 9%. And medical care, they expect to go up 8.7%. This was further validated by the University of Michigan survey, saying that it looks like inflation expectations have gone up 3 to 3.5%, up 3.3%. Why are these important? Inflation expectations can drive behavior. And it appears after quarters of inflation going down, we have clearly turned the corner and inflation is a problem. We will, of course, get validation of that tomorrow with CPI. One of the earnings report that we had to take a look at was Home Depot. Home Depot missed on revenue, but beat on earnings. It looks like the consumer is deferring major home projects due to higher interest rates. You know, I seriously wonder, is it consumers delaying, or there's another option, or have the consumer already done everything they wanted? Think about this, right? They could have pulled forward demand, right? Maybe the consumers already painted the house, already did the kitchen remodel, already put up the gazebo or whatever it is. So I don't know. According to Home Depot, they're saying consumers are delaying. I'm just wondering, with the less churn in the housing market, if really what we're seeing is just, hey, my house is already dialed in. I don't need to do anything else. So I don't know. Pretty interesting. Let's talk about Altos Research and where the housing market is. The housing market. Active inventory, this again is single-family homes. Single-family homes up 1.5% week on week. We are now sitting at 568,000. The question is, again, according to Altos Research, could we get to 700,000? Could we get to 700,000 by September? I don't know. We are definitely on an uptrend, but here's the deal, folks. If, again, big if rates come in and go sub 7, I think the animal spirits come back. I am one, and I've said it many times, I hope rates stay at 7. I want the housing market to get back into balance. I want days on market to go up. I want us, the folks that do the work, that are hunting for motivated sellers, I want us to win. And if rates fall too fast, it could get wonky again. So again, active inventory up 1.5. How about new listings? New listings down. New listings down 3% week on week, 69,000. New pendings down 7%. Price cuts did tick up to 33.7%. So what does all this mean? Well, as of right now, the market is doing exactly like we talked about. It is slowing down. 7% rates do that. 6.99, history says, does not do that. So where are rates today? Well, as of yesterday, I haven't checked this morning. According to Lance Lambert at Resi Club, rates were 7.12. Rates have really come off the boil, right? It was 7.5 seemingly 2 or 3 weeks ago. How can that be? There's this thing called the spread. We've talked about it many times on this channel. The spread currently is sitting at 263 basis points. It's actually 2.63%. They like to sound smart by calling basis points. We were as high as 310. I think we peaked at 309 basis points. So that is a roughly 0.5% spread without mortgage or without the 10-year changing. They've whacked 0.5% off the spread. How can that be? Well, I think it's just banks seeing less volume, less transactions, less lending. I think they know that they have to get rates down to spark activity. And again, even if the Fed doesn't cut, even if the 10-year Treasury doesn't move a point, rates could go sub 7 just by moving the spread. And again, as I've said many times, the historical average is 180 basis points. So they could do nothing, lower the spread 75 basis points, which means we could see rates at 6.5. If we got rates at 6.5, given the current 10-year treasury, that would be within the realm of normal. I'm not saying we'll get there. I'm just saying that is where this could go. So again, folks, lots and lots of stuff going on. Remember, we have started a school community. Your first opportunity to interact with the millionaires is tomorrow at 8 a.m. If you are a school member, you have an access to the Zoom link. You can come ask questions, participate if you would like. You can leave questions in the school community. I will answer them. We will also have an opportunity Thursday evening just for an open Q&A. And then, of course, my first one-on-one or one-on-many session with the community will be Sunday. So again, I'm looking for the school community to give back. It is obviously a paid community. It keeps out the riffraff. But yes, your chance to talk to Dion, Matt, and I tomorrow, 8 a.m., be part of the community. I'll try to leave a link below for that. So folks, you have an amazing day. Again, tomorrow's a big day. I actually still think retail sales is more important. But yeah, CPI tomorrow and retail sales. It's going to be fun. Take care of yourself. Have an amazing day. Don't forget to do the work. Have some fun. Make someone smile. Just keep being a good person. Later.